When you look at the headlines coming out of the Persian Gulf, you see a regional war. But the real conflict is happening inside the wiring of the global financial system. Behind the kinetic military strikes, the petrodollar is being dismantled. This system, which has underwritten U.S. financial dominance and allowed for record levels of sovereign debt, depends on oil being traded exclusively in dollars. That arrangement is failing. We are witnessing a paradox. While this conflict is fought over the world's most critical oil choke point, it is simultaneously forcing the world's largest economies to treat oil as a legacy asset. The events of 2026 are forcing a permanent pivot. This is the transition from an economy anchored by liquid fuel to one governed by a different kind of power. On February 28, 2026, strikes against Iranian targets led to a total blockade of the Strait of Hormuz. This choke point stranded 20% of seaborne oil and liquefied natural gas. The IEA calls this the largest supply disruption in history. Brent crude immediately surged to $126 a barrel. For buyers in Northeast Asia, ship-to-ship transfers and skyrocketing insurance added a physical delivery premium of $20 for every single barrel. While the U.S. responds with high-value arms deals to keep its allies tethered to the dollar, those same Gulf nations are looking at a market where supply is permanently tight. They see an opportunity to maximize their final oil revenues. If the world's primary energy anchor is being weaponized and replaced, we have to ask what actually happens to the purchasing power of the currencies left behind. The pressure of the blockade has shattered the old rules of the oil market. OPEC, which has managed global prices for 66 years, is losing its grip. The United Arab Emirates calculated that since the world was already undersupplied, they could exit the cartel without crashing the price. By leaving OPEC, they freed themselves to bring their full production capacity to market on their own terms. This exit leaves Saudi Arabia isolated. Without the UAE's spare capacity to help balance the market, the Saudis' ability to act as the global swing producer has diminished. The era of managed oil stability is over. Individual nations are now prioritizing immediate cash flow over long-term cartel discipline. That cash is no longer flowing back into U.S. treasuries. Central banks now view dollar-denominated assets as political tools rather than neutral reserves. In response, they've pushed gold to record highs of $4,700 an ounce. Oil trade is already decoupling. Roughly 20% of global oil transactions are now settled in local currencies like the yuan and the rupee, bypassing the dollar's traditional role as the intermediary. The BRICS payment system settles trades for just 0.1%, while SWIFT costs up to 5 times as much. To automate this, India proposes linking digital currencies across the expanded BRICS bloc, creating a direct trade corridor between energy producers and consumers. Half the global economy has effectively built an independent financial operating system. This makes it possible to trade energy and resources entirely outside the reach of Western sanctions. The high cost of oil has forced a green energy sprint across Asia. In countries like Vietnam and China, the expansion of solar and EV adoption is permanently reducing the long-term demand for Middle Eastern fossil fuels. The Gulf states are responding with a massive pivot. They are using the current $126 per barrel windfall to fund a strategy they call petro-compute. Saudi Arabia is building the world's 11th most powerful supercomputer and has launched a $5 billion AI project. They are converting their remaining oil wealth into sovereign data centers. By establishing corridor-linked hyperscale data centers, the Gulf is positioning itself as the digital backbone of the India-Middle East-Europe corridor. They are moving to control the flow of data between continents. These nations have realized that selling liquid energy is a finite business. Selling digital intelligence and infrastructure is the plan for the next century. For the average consumer, the loss of Western purchasing power isn't a temporary inflationary spike. It's a structural shift as the dollar's role in the energy market erodes. We are moving toward a period of techno-feudalism. In this new order, sovereignty is defined by who controls digital infrastructure, critical minerals, and high-speed data corridors, rather than geographic choke points. Leverage has shifted from the size of a country's oil reserves to its ability to secure and process massive amounts of information, independent of any single centralized system. The wealth of nations is being recalculated. It is no longer measured by liquid gold, but by technological sovereignty. The 2026 crisis provided the catalyst for a massive relocation of global influence. As the BRICS bloc overtakes the G7 in financial governance, the old rules of trade are being rewritten. Power now flows toward those who control the compute infrastructure and the digital settlement networks of the 21st century. The world hasn't simply found a more expensive way to buy oil. It has found a way to survive without the